My name is Kevin Ruiz, and I'm a principal with Treasury Strategies. And I'm joined today by my colleagues, Tony Carfang, as well as today's four panelists. Steve Baseby, who is the Associate Policy and Technical Director with the Association of Corporate Treasurers. Michelle Price, who is also an Associate Policy and Technical Director with the Association of Corporate Treasurers. Debbie Cunningham, the Chief Investment Officer for Federated Investors. And Roger Merritt, the Managing Director for Fitch Ratings. As we've been doing for almost a decade now, today we're going to discuss corporate cash levels, and then our panelists are going to discuss the key issues that are top of mind for you in our corporate treasury audience today. Before I begin, I want to remind everyone who's registered for this session that in a day or two, you're going to receive a copy of this presentation and a link to the recording. Before I begin, I want to remind everyone also who's registered, we'll send this out in a day or two and send you a link to the recording as well. What I meant to say was if you have any questions to ask, you can do so in the question box in the bottom right-hand corner of your screen, and we'll handle those questions offline in the coming days. So let's begin and talk about our four major jurisdictions. As we always do, we start with the US, UK, Eurozone, and Japan. If you look at the US, especially relative to the October cash briefing, we have climbed here from 1.9 trillion to 2.1 trillion in a very short time period. Part of that, we believe, and we'll discuss in a little bit, is part of influenced by money market reform, and part of that may just be holding on to cash as a result of recent activities, recent political events, and other things that are going on here in the United States. In the UK, we've gone up from 0.65 trillion to 0.66. The Eurozone and Japan look relatively the same, but we're going to keep an eye on all those levels as well. As we move forward to slide 5, you see the fit, and the time series fits as we regress against that look like they're moving as we would have anticipated. Japan's slope curve is actually climbing a little bit, and we see that because the pace of acceleration there, as we said back in October, is accelerating, and you can see that climb there. Looking at slide 6, the corporate cash as a percentage of GDP by region, you'll see that the United States has gone, and again, we're looking at about 11% of corporate cash as a percentage of GDP. That's climbed from December of 2000 somewhat significantly. You see the Eurozone, the UK have not changed since our October update. Japan has dropped a few percentage points from 50% down to 48% in September of 2016 from June 2016. And again, we see this ratio as the utilization of cash within the economy. And as normal, we would be interested in hearing anything you have to say about some of these trends. As we move forward to slide 7, and you see corporate cash relative to nominal GDP, again, you're seeing correlations relative to nominal GDP for the majors here, Japan being another story, and we suspect this is due, again, to both structural and unique technical issues. And again, we'd like to hear from anyone that's got some thoughts on that. On slide 8, you're seeing the central bank's ability, again, this is to attract reserves. And you're seeing this number here in the United States for September go down slightly to 2.26 billion from previously in October it was 2.36 billion. And these numbers are moving drastically. You see the reserve balances at the Bank of England have gone up from 170 billion up to 185. The reserves at the European Central Bank have gone from 933 billion to 1.1 trillion. And then we've seen Japan's actually climb from 273 trillion yen up to 280 trillion yen. I'm going to hand this off now to Tony, who's going to do a deep dive into the shifting political landscape. Tony, go ahead and take it from here.
Thanks, Kevin. Well, those were fascinating numbers, and I think as you can see, cash is rising, but the movement, and particularly the central bank activity in different jurisdictions, is actually moving in different or inconsistent directions, which certainly is a reason for corporate treasurers to pay close attention to this. Every year in January, at the end of January, Treasury Strategies delivers our annual State of the Profession message, and we have that coming up actually 2 weeks from this morning. And last year, we actually had as slide number 2 in our theme for the year, expect the unexpected. And I think if any of us who attended this last January would have been told that Donald Trump would be president of the United States and Britain would be leaving the EU, we would have thought that person was crazy. But that's a fact that we're dealing with now. And it's among Treasury Strategies clients, there are a number of factors that are impacted by this shifting political landscape. On slide 10, we see here, so a couple of the forces are, Brexit, and you have a new British Prime Minister, Theresa May. The U.S. elections bring in not only a new president, but a strong Republican majority in both houses of Congress. We've had elections in Italy that have moved from center-left to center-right, and we have elections coming up in France and probably Germany that will also sort of impact the sort of political and regulatory mindset that drives the economies that we are all participating in. And as you can see on slide 11, there are a number of issues that come into play, and the trends around these things could actually be in for quite an interesting reversal. And the implications for this are global. On the regulatory front, we think, I think Brexit tells us, and the U.S. elections, among other things, that there's a mindset developing that some of the post-crisis regulation may have gone a step or two too far, and we would expect going forward to see some significant reevaluation of both the specific regulations and the reach of those regulations, particularly the reach across jurisdictions. Probably a move toward less global regulation and more jurisdictional specific regulations. But the fact that this will undergo some reexamination and probably some scaling back sort of changes the profit dynamics of the banking industry, changes the relative position of economic players around the world. This is something clearly to keep an eye on. Taxation. There's significant divergence in taxation in different jurisdictions, and particularly if corporate taxes in the U.S. were to drop substantially, we'd be looking at some pretty significant economic flows that would result. And obviously that's a concern for corporate treasurers, for bankers, for fund managers worldwide. The role of central banks, I think, is going to come under reexamination. We see, particularly as we examine the political winds, that the chorus of folks who think that the role of the central banks in most economies around the world has gone too far, that the balance sheets are too large, and that the money market and securities holdings of central banks may be creating distortions. That crowd seems to be gaining traction relative to those who believe that the centrally planned economies, centrally planned and controlled economies, should dominate. So that could be an interesting shift in the winds. Interest rates, always a wild card, and again, what the central banks do and what happens with regulation and taxation clearly impact the interest rates, which then directly lead to capital flows and foreign exchange volatility. And then the final implication here, I think, is on trade policy, where we see in the political winds something that could be more restrictive in the trade area. Although we're not quite sure how things play out in the long run. and how these variables interact. One of the things we want to do at Treasury Strategies for our clients is to engage in dialogue on these topics so that we can all gain a deeper insight into how these things are impacting the marketplace. On slide 12, we'd like to look at the U.S. landscape, and particularly in terms of some specific, what we call institutional views. The institutions, we've listed 4 here that we think could seriously be impacted in 2017 and beyond. And the first is the role of the Federal Reserve. Again, the political winds have put in place a team that believes that the role of the Federal Reserve might have been too powerful and too independent, and that might shift. There are cries to audit the Federal Reserve's activities, which there are 2 sides to that sword. More control might be a good thing, but at the same time that invites political interference, which is not a good thing. But we would expect the role of the Federal Reserve over time to diminish somewhat from the role it currently enjoys. The U.S. Supreme Court now is locked in a 4-4 split along ideological lines, and there's an empty seat that is likely to move in the center-right direction, but could remain vacant for some period of time. The significance of this is there are a lot of issues that concern business and economic activity that could be presented before the Supreme Court, and we would expect to see sort of a center-right outcome going forward, which is not necessarily a big change from where we've been, but nevertheless, it's an impact as a result of the election. Number 3 that we have up here is FSOC, the Financial Stability Oversight Council, and we would expect that this organization is going to be put under a microscope. The FSOC is a sort of a super regulatory organization in the U.S. that sits above the primary regulators. It sits above the Fed, Treasury, the Securities and Exchange Commission, the Commodities Futures Trading Commission, and all of those other regulators, and is comprised of the heads of many of those regulatory bodies, and is chaired by the Secretary of the Treasury. I think historically, and FSOC was created by the Dodd-Frank rule, FSOC kind of gives regulators a second crack at controlling the regulated. For example, in the money market regulatory debate over the last several years, it was when Mary Shapiro was chairing the Securities and Exchange Commission. She was kind of moving slowly on money market regulation, which she felt was the appropriate way to go. And FSOC, through jawboning and persuasion, sort of leaned on the SEC to actually develop the regulations that Mary Jo White, when she took over as chair, ultimately implemented with the fluctuating net asset value and the fees and gates. The issue with that is, sort of gives the regulators 2 bites at the apple, and it leaves the regulated kind of helpless and uncertain. And our sense of Treasury Strategies is some of that will come under reexamination. And then finally, among other institutions that will be under the microscope, is the Consumer Finance Protection Bureau, which, as noble as that title sounds, is a regulatory body that, unlike the others, is not ruled by a commission but a single individual, and whose budget is independent of the U.S. Congress. And what the problem with that formulation is it's kind of off on its own, and under the wrong leadership, or under a strong ideological single leader, this would clearly run off the rails. we've seen some of this in the sense of trying to, industrial companies who offer things like Christmas layaway plans or advanced deposits or gift cards or whatever. The CFPB has actually deemed them to be financial institutions from a regulatory standpoint because they're taking deposits, because they have a gift card and things like that, which is exposing corporate treasurers to significant risk. Many are not even fully aware of. We would expect this to come under reexamination, particularly from the standpoint of having a single executive rather than a bipartisan committee running the institution, and the budget independence that it currently enjoys. Now, moving on to slide 13, there are specific regulatory activities that are likely to be on the agenda. And again, we're focusing on the U.S. here, although there's obviously a global implication. The House Financial Services Committee has talked openly about repealing Dodd-Frank, and within Dodd-Frank, I want to point out that the Volcker rule is part of Dodd-Frank. There are several chapters in Dodd-Frank that are going to be impacted here, and I'm going to come back to this when I talk about regulatory capture in a bit. But suffice to say, at this point, Chairman Jeb Hensarling of the Financial Services Committee, as well as Michael Repo of the Senate Banking Committee, have some thoughts on radically restructuring Dodd-Frank. Basel III, there's a lot of discussion in the new political circles about whether that rule has gone too far, whether the net stable funding ratio, which is scheduled to go into effect next January 1st, will actually be harmful to banks and go far beyond what's needed. And sort of a rebellion against the one-size-fits-all prescriptions in the various ratios under Basel III that are in effect worldwide, and a question about whether you really can have a global one-size-fits-all kind of banking regulation. So we expect that to come under examination. In terms of money fund regulations, it is absolutely clear. In fact, I testified at a hearing at the House Financial Services Committee about 3 or 4 weeks ago. None of the members of Congress expected that the fluctuating net asset value in the money fund regulations would cause $1 trillion to leave prime funds, which invest in private sector enterprises, to move into government funds, which basically take the money out of the private sector and put it into the public sector. It's a capital shift, and I can tell you every member of the committee who was present on both sides, the Democratic side and the Republican side, felt that this could not be a good thing to have $1 trillion move. I pointed out in my testimony that $1 trillion moving is actually more money than politicians are expecting to happen if cash gets repatriated back into the U.S. from overseas. I pointed out this is more than the entire TARP program. This was more than the President Obama's stimulus program in one, small regulatory corner of the money market. And while there is no agreement that on how to resolve the problem, there was unanimous agreement from the House Financial Services Committee that something was wrong and needs to be fixed. So you might say we moved the ball down to about the 35-yard line there, and we'll see where it goes from there. IRS Rule 385, which is the overseas corporate inversions and overseas corporate cash, will be in focus. Some extent, and that ties with the taxation bullet there. If U.S. corporate tax rates are lower, there's some sense that the overseas corporate cash issue could take care of itself. And I think we're going to see a lot of permutations and combinations of proposals coming out on that. The last point I'd like to leave you with is one, and you probably heard this in economics, called regulatory capture. And it'd be interesting, fascinating if you Google this and figure out what the heck's going on. But it's, essentially it is that the regulated, in effect, figure out how to profit from the regulators. And we're seeing a couple of interesting things here, like in the case of Dodd-Frank. So we've heard for years the bankers and fund managers and business executives saying we have to repeal Dodd-Frank, we have to repeal Dodd-Frank, we have to repeal Dodd-Frank. And now that you look around at Congress and the White House and whatever, and you say, gee, they might repeal Dodd-Frank, we're having senior bankers from around the world say, well, gee, maybe there's some good stuff here. Let's slow down a little bit. And that's an example of regulatory capture where, now some of the biggest banks are thinking, you know what, we figured out how to profit from Dodd-Frank. While we don't like all of our new regulatory costs, those regulations impact smaller institutions more significantly than they impact us. So competitively, we have figured out how to turn Dodd-Frank into a competitive advantage. So maybe we really don't want to repeal this. It's going to be interesting to see how that plays out. But that's the note I'd like to leave you with, and I'll then turn it back to Kevin to go to the panel.
Thanks, Tony. I very much appreciate it. It's funny, especially your comments on regulatory capture. I think a lot of industries, as the change in the change in leadership has happened from the election, there's a lot of industries where this is going on, not just in finance. I think we can all look at healthcare as seeing some of these same issues. So let's start by piggybacking a little bit on Tony's discussion around the elections and potentially the regulatory impact. But let's start from more of a global view. Steve Baseby, maybe you could start us off here by talking a little bit about the view from the UK and what thoughts are going on there and in Europe as far as not just the U.S. elections, but the global change and what that means for regulatory changes globally as well.
Money markets, although there were worries about year-end cash flow management, but now people are getting their heads up and looking forward. The main expectation is that interest rates will go up. They will go up largely because inflation is rising, but they may go up because of government policy in itself. We've seen your election over there, the impact that could be seen, the one Tony refers to, the repatriation of a large amount of cash, which is currently sitting somewhere stored offshore, of which we believe a large part is sitting here. And so that may resolve some of the liquidity problems in the London money market by simply creating problems in yours. Those two factors going on, but we also have other factors coming in. The legislation we're most focusing on as corporate treasurers at the moment is the start of what is known as BEPS, the profit erosion, profit shifting legislation that's driven by the OECD, which means that while treasurers at the moment may have one thought of borrowing more long-term cash to lock in the rates in the current market while they can. The question there is, will they get the interest rate deduction for it fully once they've got it? And there'll be some thinking around balance sheet structures coming out of that. What we don't know, we haven't had any feedback from our members to suggest, is whether that will move them off their current policy of holding substantial amounts of cash short term. That policy seemed to be quite well entrenched through last year. The reasons quoted are usually quite varied, but a lot of them come back to uncertainty and concern over market disruption. Perhaps the drive to put some kind of control on interest rates in the UK will affect that. But I think the main thing in people's minds at the moment is where are interest rates going, which means that the days when you were holding all your cash short, waiting for rates to rise, may finally come to an end, and they will start putting some of that out.
And we were talking, I think it was last week, we were talking a little bit about, you know, I was saying what my impressions were, and you had a point specifically around the president-elect and saying, well, this is a guy that comes in with some business experience. If nothing else, he has some exposure to the business cycle, inflationary environments, all that kind of stuff. So,
yes, I appreciate that. So speaking as Americans, you may have some very dogmatic views about Donald Trump and whether you like him or not. From our view, it's interesting to see this non-establishment character come in. One is coming in from a commercial world, one who's not from the classic lawyer background. I mean, he shares with the Clintons an interest in property development, but he comes more from a pure commercial background as opposed to a technocratic and legal one. It'll be interesting to see how that translates to policy. It'll be interesting to see if he really does get all the corporate cash repatriated and into American tax system, and whether he really does manage to shift that reduction from Mexico back north of the border. I think the point for us is possibly looking forward to the elections coming up in Europe.
Yeah.
That we may see a drive to people who are more orientated in their thinking towards their own countries and less interested in trying to show off across the border. We have, at the moment, we're watching the French election unfold with a series of primaries similar to those you hold in the US. The left-wing socialist primaries are going on at the moment. We have the National Front shifting its policy to look a little bit more like a centrist government, but we're seeing the same in Italy, where the radicals led by a chap called Beppe Grillo are beginning to move their own policies more to the center as they get closer to a real electoral opportunity. So this looks like we're seeing people who come from non-traditional political roles into government. We appreciate that it creates great uncertainty. If you didn't particularly want Mr. Trump, you may be sitting there with a sense of loathing that you've got him. And we may well see similar people over here. Yeah. Uncertainty, though, you know, the thing we sign off our tend to sign off our article says, well, uncertainty creates risks, and after all, we make our money out of risk management.
There you go. So, and there's always an opportunity for things like regulatory arbitrage and all sorts of things that unfold as you see these elections unfold, as Tony mentioned, in Italy, France, and in Germany as well. You know, Tony made another comment about money market fund regulations, and I want to introduce Michelle Price in this conversation. Michelle, you and I had talked last week about the changes from money market fund reform as funds are moving, at least here in the United States, from prime to government funds and potentially into other instruments. You had made a mention about Chinese money market fund reform, or at least money market funds. Maybe you could give us a little bit of color around that.
Yes, thank you, and good morning. I mean, little is known about China's money market fund industry, and in fact, the first Chinese fund manager opened for business in mid-2001, and for many years, you know, the business money market fund levels stayed about the same. But between 2011, 2012, and all the way up to 2015, I don't have the most recent numbers, but the number of Chinese money market funds increased from about 50 to about 240. And interestingly, assets under management during that time rose 14-fold, that's 1-4, to Chinese yuan 4.6 trillion. And that's about 500 billion sterling and obviously a bit more in US dollars. So globally, renminbi's money market funds now account for 13% of global money market fund assets in the world. And that's increased from 0.5% in 2010. So the money market fund in China is growing in significance. It is a highly concentrated industry. The top 15 funds hold over 60% of assets under management, and historically they've focused their performance as being the key differentiator between each of the funds. While the Chinese money market fund industry remains dominated by retail investors, there has been a niche AAA-rated money market fund develop, and these are really for the local companies and also for multinationals operating in China. The China Securities Regulatory Commission has written new guidelines. They wrote the original guidelines back in 2004, and last year, 2016, there were new guidelines issued. There have been some significant changes for these money market funds, and these will particularly impact the retail investors. But for the domestic AAA money market fund guidelines, the international rating agencies, such as Fitch, who we've heard from, these will remain significantly tighter for China. So, for example, under Fitch ratings, durations are shorter and concentrations are tighter, and credit quality limits are significantly stricter than really still what the China Securities Regulatory Commission offer.
Great, thanks. Hey, Debbie Cunningham, you have, and I'm going to take a different approach. I'm going to ask that you add your thoughts around China's money market reforms, and then we'll go more broadly and step back and get back to the conversation around regulatory impact globally into the United States. But I believe you had a different, or at least additional information or an additional view around China's money market fund, I guess I'd call it market.
Sure. I agree 100% with Michelle in that a good portion, the very largest substantial portion of China's money funds are retail in nature. And if you look at that and think about the comparative nature in the U.S., the retail investors really weren't impacted as much. They did have gates and fees associated with them, but you know, when you think about regulatory reform and who it was impacting in the United States, it was mostly the institutional investor. In addition to being retail-oriented, though, in China, it's also very transaction-oriented, and their largest fund, which I'm not even going to try to pronounce, but it's run by a firm, it's offered by a firm called Alipay, which is part of the Alibaba umbrella, and it's essentially a way, it's a PayPal-like system by which the funds, in order to pay through that entity, you open up an account, which essentially then becomes your money market fund. So it's very transaction-oriented. It's used in a similar way to how PayPal is used here in the United States. So very, very different market. And along the notes of what you were mentioning from a quality perspective or a risk mitigation parameters, nowhere near what we have here in the United States, unless you're in that AAA-rated segment, which is still very, very tiny at this point.
Thanks,
so I think they're up and coming, but I don't think they're what we think of as traditional money market funds here in the United States.
Thanks, Debbie. Thanks, Debbie. More broadly, Debbie, just from your point of view, whether you know, it's the point of view of the United States or even Pittsburgh, if you like, what is top of mind from your point of view as far as the changing regulatory landscape and anything else that you can think of as top of mind coming out of the recent elections here in the United States and what's going on globally as well?
Sure. Well, first of all, from a Pittsburgh perspective, I'm just going to say go Steelers. But aside from that, let's put that. Let's put sports aside. We'll put sports aside, and you know, from a regulatory standpoint or from an election standpoint, I think you've got obviously the FOMC at this point looking at potentially higher rates in 2017 than had been initially thought. We had a rate hike last month, expectations for 3 more of those in 2017 from the FOMC's dot plots. And I think, part of that movement from 2 to 3 expected movements in 2017 are based on the results of the election and what might likely be more inflationary type fiscal policy that requires a little bit more interaction from the Fed's perspective. Having said that, I would caution that any change that occurs as we go past, next week's inauguration takes time. The implementation of change in sort of the normal configuration of politics and changes from a presidency and a cabinet standpoint are substantial. In this case, I think they're even longer because we've got more of a wild card here of unknown. We have a president that's never been in an elected office before. Many of his cabinets, I think I read where there was something like 43% are out of business, not out of politics, and
right.
That compared to, I think that highest previous was Ronald Reagan's at something in the teens, some percentage in the teens. So, it's substantially different than what we've historically dealt with, and for that reason alone, I think implementation and perhaps some of the results of this unexpected election surprise are going to take even longer than certainly the first half of 2017 and maybe all of 2017.
That's a really interesting point, that the ability to force change isn't as quick as maybe what some of us are thinking. Hey, Roger Merritt, this is kind of where I want you to jump in, maybe get a point of view of your experience.
Well, I found all the prior comments very interesting. I thought Tony's comments on money fund reform and sort of the current state of thinking, the 35-yard line analogy was very interesting. I think there's a lot of irony that the industry finally, after much effort, implemented money fund reform in October, and we saw over $1 trillion of assets move out of prime into government funds, as Tony mentioned. And it's a real testimonial to the industry that they managed through all that with really no hiccups. So I think but the irony is that shortly thereafter we had this sea change in the political landscape and very likely the go forward regulatory landscape. But one thing I wanted to add was that we post-election, we did an informal survey of some of the largest money fund managers in the U.S., and Debbie may have a different view on this, but their view was that they weren't overly hopeful for a significant rollback of the money fund reform in the U.S. And then I would also add one other point of irony is that shortly thereafter, or shortly later in the year, we obviously had the EU finally adopt its own money fund reform regulations. So, a lot of things have happened, and in some ways, it's I see a pretty significant divergence, perhaps, between the regulatory environment in the U.S. versus a more static and approach coming out of the EU. So, I think that go ahead.
It's funny, Roger, because when we talked last week, and as we move from this topic on regulatory impact to the spike in corporate cash, I asked you, hey, how, what are you seeing out there globally? And you said, there's a new sheriff in town in the United States, and it's going to be the wild, wild east that he's going to have to deal with. and that I almost titled that as this panel discussion, because I just thought, there's a lot of change, there's a lot of disruption globally, and it's good to have these panel discussions that think about, what's going to be consistent, what are we under anticipating, and what are we over anticipating, right? So that's great. Hey, Roger, as we talk about, there was a spike in corporate cash in quarter three. And we see, I don't know if I want to call it a phenomenon, but some sort of trend of bank deposit movements at quarter end. Maybe you could talk a little bit about that, and maybe if you think that ties to the regulatory environment or whatever your thoughts are there.
Well, I think there's always been sort of balance sheet window dressing, if you will, at quarter ends, and I think that certainly the regulatory environment is more stringent now than it was historically, and so I do think that's an important feature. Things like liquidity coverage ratio, mean that banks are incentivized to manage down their balance sheets at quarter ends, and that does have an impact on demand for deposits and just generally supply in the money markets and in general. So I think but the perhaps more interesting issue is just what happened to rates in the U.S. You know, with $1 trillion of assets moving out of prime money funds and into U.S. government money funds, you know, we saw a quite material spike up in short-term funding rates and the spread between prime assets and risk-free assets. So, you know, that in turn had, I think, knock-on implications for access to funding and cost of funding for a lot of banks and higher-rated corporations. So, you know, whether or not any of that kind of reverses itself over time with, you know, flows back into prime money funds or alternatives to prime money funds is, I think, is a big open question.
Steve Baseby, Michelle Price, your thoughts here regarding these trends? You know, there was the U.S. spike, but there's also movement in the other jurisdictions.
Yes,
what do you see happening?
We see a quarter-end effect here, and it was quite severe at the end of December. Two factors which were of concern in the London market is one is there's a bank levy charged on gross deposits as at the quarter end, which means banks certainly don't want unsticky money deposited with them. But the other was there was a shortage of high-quality liquid assets in the market, and under the EBA rules, banks must hold somewhere between 40 and 100% of their very short-term deposits. They have to hold high-quality liquid assets against those, effectively government bonds. And so those two factors meant that the window dressing as such was slightly less window dressing. It was cost-cutting and managing your asset position. So these factors came into play, as well as the fact there seemed to be quite a lot of cash in play, and at a time when we've seen the population of banks in London diminishing as they balkanize, as the word they use over here, but effectively they move back to their domestic markets. So we had those factors on top of any normal window dressing for Basel III. And looking forward as to what's going to happen during this year, we're having a huge debate going on over what has sort of been referred to as Basel IV and how the EBA enforces that. And this is a debate now falling into the political area. But we also have the introduction of IFRS 9 accounting standard. And it's estimated that banks' requirement for loss provision will have to increase by about 30% to cover that, further constraining what banks do. So all these factors are coming together on the banks, and this is making them far more reluctant to access just somewhere where you stick your billions at the quarter end. And it's not just something for the fund management industry, it even impacts on some of our larger industrial organizations and the way their cash flow, unfortunately, times in with the quarter-end process, and they have to manage that all at once. So it is a point, I think, with what we're seeing as a real economy people trying to manage real money is a regulatory structure which is working against the banks, and in particular is giving this quarter-end reporting constraint on the banks, which is getting worse, not better, as time goes by. Why we're seeing the shortage of high-quality liquid assets, we don't know. It will affect the reverse repo markets. It affects the bank deposit market. We're just not too clear. My own suspicion is probably the natural holders of these things, who are the pension funds and insurance funds, preferring not to lend them out into the market and just sit on them. But we have no statistics to support that. It's just a matter of saying, so what option is left to explain it. But this is these factors are at play in our market over here. We're not quite sure how they're going to unwind. But the regulation, the Basel III as the root source, is having a serious impact now.
Michelle, did you have anything to add to that?
No, I think Stephen summed that up very well.
Yeah, absolutely. Thank you so much. Hey, Debbie, you know, and it goes right to what Steve just talked about regarding the reverse repos. I was going to ask you about the issues such as the shortage of available securities and so on. Maybe you have something to add to that?
Well, I'd just say that I think certainly traditional counterparts cut back at month ends and quarter ends, much more so than they have historically, and I think that's due to the regulatory implications. So banking counterparts in the repo marketplace are way cut back on a window dressing basis for month ends and quarter ends. You know, and I think the outlet for where does that cash go, since it can't go to the traditional counterparts, is the Fed's reverse repo facility. From a 2a7 standpoint, 47% of December 30th repo was done with the Fed. So that's, you know, half of the market was done with the Fed. And there are problems with that. Number one, not everybody is a participant with the Fed, only the largest funds, you know, that have a lot of historical information about them. And number two, that facility cuts off at 1 o'clock. So, you know, when people are used to trading in their accounts up until 4 or 5 Eastern Standard Time, if you have a 1 o'clock cutoff, that's a problem. I think one of the things that Steve mentioned about, you know, the cash being somewhere where they've decided, or the collateral being somewhere where they've decided not to lend it, is more a function of, to some degree, those counterparts not being credit worthy, if you will, so pension plans, other types of entities that have the appropriate collateral but maybe don't have ratings or aren't used to dealing on a peer-to-peer basis. And, you know, I think that those things will spawn and grow in 2017. But they're in their infancy right now. It's not really a shortage of collateral. It's how to get it into the hands of those that want to finance it.
Yeah, that's really interesting because it's kind of operational as well as policy driven, right? So, you know, you were just talking about the participation and cutoff times. I think a lot of this is operational as well. So very interesting. Hey, before we close out, let's talk about one more issue, which is not just the interest rates, but what else is out there for 2017? Debbie, you had talked, you know, a few minutes earlier about what the Fed's planning on doing in 2017 as far as interest rate increases. Do you have any other thoughts around not just U.S. rates, but global rates and yield curves and what we might see in 2017?
Well, I do think that as each Fed dot plot came out in each quarter of 2016, and really as each new ECB discussion came about, or each new FSA discussion came about from a UK perspective, throughout 2016, the outlook got worse. The yield curve got less steep. There were, you know, initially, if you recall back in the U.S., the Fed said we were going to tighten 4 times in 2016. Well, you know, we made it to December without tightening at all. Right. So I think 2017 will differ, especially for the U.S., but for others also, with revisions more on the upside. You know, expectations from a market perspective are probably still 2, maybe 3 moves with the new, you know, the newest Fed information. But I think as we go through, you know, the first half of 2017 and those dot plots are released and statements are released, you're going to see revisions on the upside, I think, rather than the downside, which is sort of what we've gotten used to over the last couple of years with you know, monetary policy in the world being, you know, very, very low and very negative.
Mm-hmm. And it's funny that you characterize something there, which is the market's perspective. And, you know, for the last maybe month, I guess now, since the U.S. elections at least, I've watched the markets move, and I've seen, for the most part, optimism as far as the commodities markets and the equities markets. I can't say the same about the money market, well, I guess the money markets, but we'll see. Roger, what are your thoughts here, both the trends for 2017 in the U.S. as well as globally?
Well, I mean, I think, you know, I guess I just echo some of those views that clearly we seem to be in at least the market's perspective is that we're going to be in a more favorable regulatory environment going forward, albeit it may take some time, and therefore there's expectations for growth, and that in turn feeds into inflation expectations. Fitch's baseline forecast is for two separate 25 basis point upward moves by the Fed in 2017. So, well, I guess you can call me at the end of the year and see if we were right. But
we'll be on the panel again in October of this year, and I'll ask, and you know, we'll go back then and look at our homework and see if we did well. So That'd be great. Hey, Michelle Price, before we end up, your thoughts here, especially if you have any thoughts from the point of view of Europe or Asia Pac on 2017.
I mean, on interest rates, I mean, as we're all well aware, they've remained historically low in Europe and the UK for many years now. There is more volatility in the market. There is an expectation that rates will increase when, you know, no one really knows. Inflation is supposed to increase here in the UK, and I think that will potentially have a knock-on impact. I mean, the big issue in the short term here in the UK is Brexit. There's a deadline or a set deadline of March for Article 50 to be enacted, and it's sort of a watch this space at the moment. So in the short term, I think the real issue here in the UK is Brexit, and longer term, who knows?
Absolutely. Thank you, Michelle. Steve, to close us out, any thoughts on 2017 and what else is out there?
No, I think the domestically, people are going to wake up to the further constraints on banks, coupled with the changing government policy, tax policy on interest rates, and that could have a fairly big knock-on in the UK markets, both the long and the short, as to how people behave in reaction to that. But really, the important thing for us is how the debate over Basel III/4 falls out amongst the regulators over in this part of the world, and whether they're really going to push everything to the limits or they're going to start backing off and realizing that they're beginning to constrain the banks far too much.
Gotcha. Thank you so much. You know, it's interesting times as we go into 2017 for sure. Thank you so much to everyone who participated in today's panel. Again, Steve Baseby, the Associate Policy and Technical Director with the Association of Corporate Treasurers. Michelle Price, also an Associate Policy and Technical Director with the Association of Corporate Treasurers. Debbie Cunningham, the Chief Investment Officer with Federated Investors and a Steelers fan. And Roger Merritt, the Managing Director with Fitch Ratings. Most importantly, on behalf of Tony Carfang and all of our panelists, thank you all so much for listening in today. As usual, a link and a copy of today's materials will be shared with all registrants in a few days. And if you have any questions or comments, please feel free to contact me or any of our panelists at our respective emails. One final note, I grew up in Kansas City, Missouri, so go Chiefs. Thank you so much, and we'll see you on Thursday, April 13th for our next cash briefing webinar. Stay safe.